Friday, July 30th, 2021, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at how, in my opinion, we are already in a slowdown, and it's a stagflationary slowdown. What does stagflation mean? Well, back in the 70s, the mainstream economists, just like today, and they are, of course, mostly Keynesian, thought that you couldn't have a slowdown in the economy, high unemployment, with inflation at the same time. They didn't realize that you could, because you had a fiat currency system. You had the debasement of the currency, which is really inflation, and you were crowding out the private sector. Yes, and you had stagflation, and they were very surprised back in the 70s. I always remember learning about that at university. At least they taught us that. And also back in the city of London, in the financial markets where I worked from the late 80s till around 2012, we always spoke about in the 90s how stagflation was a surprise for most economists. And they seem to not have learned the lesson of the 70s that we can have stagflation, that we can have a slowdown and higher prices. So, and I'm going to show you today through the numbers, through the data that we've seen recently. For example, yesterday we had the US GDP data for the second quarter. So from April to June. As you can see here, US economic growth weaker than expected in second quarter. GDP advanced 6.5% on an annualized basis, as strong consumption was offset by lagging private investment. So yes, private sector is being crowded out. This data was expected at 8.5%. And I've been noticing in the last 2 to 3 weeks that a lot of the data that are coming out for the US have been lower than expected. And I think that's a bad sign, especially when we're seeing governments all around the world, especially in the US. I think they just announced another 1.2 trillion fiscal package. When government is being so profligate spending, they're going to crowd out even more the private sector, and it's going to make things worse. So I learned this from an economics professor in Geneva. He was actually a banker. He was an interesting guy. He was a musician as well, and he worked for Bankers Trust, if I remember well. And he used to bring these Bureau of Labor Statistics and publications from the US government, because back then there is very little access to online things. Well, there was no internet back in the late 80s, so to speak. And we went through all the data, and that's how I came to the conclusion at the time, 87, 88, that's when it was, that the US economy looked like it was going into a recession, and that proved to be right. And I actually got those publications as well. I think I had to pay something to get it from the US government, so from the statistics office, BLS, or whoever it was. And they sent it to me, and you kept track of that. But nowadays you can go on investing.com under the economic calendar. And what I've done here, I've gone back 3 weeks, and I've just put the US on it. You can have as many countries as you want, and you can set the data. And I've gone back to around the 13th of July. So this is data from June. And it's not surprising then that GDP is slowing down. And we're also seeing costs go up. We're seeing prices go up. We're seeing the consequence of inflation, which nowadays, of course, they call it inflation. So, for example, On the 13th of July, CPI came out at 4.5. That's core CPI. It was expected 4%. The headline CPI was expected at 4.9. It came out at 5.4. So yeah, higher prices. That's deflation part of the stagflation. So let's go through some more of these numbers. We had the next day, we had PPI. That's the producer price index. That's what producers are suffering in terms of rising costs. Well, the number was expected 6.8% year on year. For June, it came out at 7.3. Let's have a look here. Keep going. On the 15th of July, on the Thursday, we had the Philadelphia Fed index. And you might think, does that really matter? Well, the markets like looking at this number, the Philly Fed index. It's a number that the markets look at for some reason. That came out at 21.9. It was expected at 28. So not a good number there for the Philly Fed. On the same day, you had jobless claims. It came out as expected at 360,000. On the same day, we had industrial production and manufacturing production. Industrial production came out at 0.4, was expected 0.6. Manufacturing came out at minus 0.1, was expected 0.2. So Friday the 16th, we did have some strong retail sales data. It came out at 0.6, was expected minus 0.4. So yes, there was a stronger than expected number there. But as you've seen so far, a lot of the numbers have been worse than expected. And then you go to the week of July 19th, you get building permits expected at 1.7 million. They come out at 1.598 million. That's a huge miss. Housing starts did come out a bit higher than expected. And then you come to Thursday, July 22nd, jobless claims jumps from 368,000 to 419,000, and it was expected at 350,000. Existing home sales was expected 5.9 million, comes out slightly lower at 5.86. And then on the 23rd of July, you get service PMI, Purchasing Managers Index. This number, if it's above 50, it means the sector is expanding. But it took a huge drop. It was expected at 64.8 and came out at 59.8. The previous number had been 64.6, so not a good number. New home sales came out Monday this week, was expected up 3.5%, dropped 6.6%. Durable goods came out on Tuesday, was expected 2.1%, came out 0.8%. Let's have a look. Then you had the GDP numbers yesterday. They were expected 8.5%, came out 6.5, as I said earlier. And the interesting thing about this GDP number is that they have the prices paid number, or PCE prices for GDP. So it came out at 6.4%, the PCE for the second quarter. That jumped from 3.8% in the first quarter. So that's even higher than that 5.4% CPI. The core PCE, which is what the Fed looks at and has a target of 2%, guess where that came out? 6.1%. Yes, it was expected 5.9, so it's even higher than expected. But the previous number is 2.7%. So a huge discrepancy there with their goals and where they're letting inflation go, right? And I think I've gone through enough to show you that things are not well. And we've got as well at the end of this month, I think it's tomorrow, there's going to be millions of people that are going to probably become homeless, because I think the CDC exemption for rentals expires, and unless they extend that, there's going to be a lot of trouble out there. The economy is going to get even worse. Commodities are picking up again, as we've seen. Copper looks really good. We got other things picking up like coffee. Yes, I know there is a freeze in Brazil, but coffee has been going up since last year. And yes, commodities, they only corrected recently, but they're back on the upward path. The CRB index hit multi-year highs just a few days ago. So things are not going to improve, in my opinion, in terms of the economy, in terms of prices and costs. Even in Europe here, there's an article this morning in the FT talking about the gas crunch sends prices hurtling higher. And by gas, they don't mean gasoline like in the States. They mean natural gas. So tidal global supplies exacerbated by lower Russian volumes and declining European production. So natural gas prices in Europe and the UK have soared to some of the highest levels on record, threatening to raise costs for households and businesses as global supplies of critical fossil fuel remain tight. So you kind of wonder with the health derivatives now, because these people love financial derivatives. They also love the health derivatives. Whether all the talk of more lockdowns, more restrictions because of this health crisis is going to be used as a scapegoat for the fact that the economies in the West, despite all the propaganda that things are great, they're picking back up, are not really doing that great. And I think we're going into a leg down in terms of economic activity and leg up in terms of costs. That's the worst possible scenario. It's stagflation. So that's how I see it. Not looking great. I wish I had more rosy news for you. But the thing that I would say though is that there are opportunities in any kind of environment, and hopefully, if you're positioned well for this kind of environment, I think you could do well. And as I've said before, hard assets, gold, silver, living within your means, trying to be outside the system as much as possible. I got a notification from NatWest, my own online banking app, to look at my credit score. So I looked at it just out of curiosity. It was very good, but I don't use credit. So yeah, that's another way of avoiding the pitfalls of the Keynesian economic cycles, which seem to get worse and worse and seem to be headed towards stagflationary, if not hyper stagflationary. That would be something that we haven't experienced in the West, well, for many, many decades. And with that, I just wanted to show you that in Venezuela, in the south of Venezuela, and this is probably in a small town or a village or a small city near probably where they do some gold mining in Venezuela, but it's in Spanish, the article. I'll put a link to it below in the description. You might be able to get a translation. I understand Spanish because being originally from Brazil, we speak Portuguese there, and it's quite similar. So what they're doing in the supermarket in this town, people are paying with gold nuggets, little gold nuggets, and the prices for products are either in dollar or gold. And there's a little TikTok video where they show the people shopping with gold, and they use the banknotes to wrap the gold in. So at least the banknotes are of some use to put real money in. So it shows that those people who say, oh, you can't go to the supermarket and buy things with gold. Well, in Venezuela, they're doing that. And some people might say, oh, how do you know it's gold? Well, you do know what gold is, especially if you're dealing in it. I have a little nugget here. I think it's just about 3 grams or something like that. I bought that many years ago on eBay, and I can tell you it's gold. The first test to do is with a magnet. If it doesn't stick to the magnet, it's probably gold. So with that, let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. Yes, gold and silver kind of woke up yesterday. I'm not getting enthusiastic. I try to stay pretty level-headed no matter where gold and silver go. Yes, I know it's been a tough last almost year of consolidation and correction in the precious metals. But it's looking better. I think gold has gone over the 50 and 200-day moving average right now. I think the key level from listening to other technical analysts like Michael Oliver, who's a very good momentum analysis analyst. He's been on this channel, and I listened to him the other day, and he said 1920, which was the previous all-time high in 2011. That's not the important level. The important level is going to be around 1850 and 60. He thinks that if we break through those two levels there, 1850 or that area, gold could catapult a lot higher. We'll have to wait and see. We've been patient. Things seem to be getting better right now. So I would just sit tight and know that things are not getting better fundamentally, and that if anything, the central banks, especially the Fed, are going to have to keep accommodating, because as you saw, the economies are not doing great. So right now we've got spot gold at 1830.80. That's up just over $2. Range has been relatively narrow this morning or overnight. 1831.50 to 1825.80. Silver is up 9 cents at 25.58. Range has been 25.45 to 25.65. The Dow future is down 150. The NASDAQ future is down 200 points. I think that's on the back of Amazon. They came out with results that disappointed. So down over 1%. And we know that the NASDAQ has been driving all the stock markets, the tech sector. Am I saying there's going to be a crash? No, but things are looking a little bit toppish. We could see range trading or a bit of up and down and volatility. Who knows? The S&P 500 is down 39 points, just under 1%. The FTSE is down 71 or 1%, just above 7,000. Now to the currencies. We've got sterling unchanged at 139.66. Yes, the dollar has continued to move lower. It's still quite far away from some key technical levels further below, but it's looking like it's keeling over versus other fiat currencies. The euro is unchanged as well, just below 119. Dollar unchanged versus the Japanese yen at 109.55. Dollar is a little higher versus the yuan at 645.97. The Aussie dollar is down an eighth at 73.85. And the dollar is unchanged versus the Canadian dollar at 124.39. General commodities, we got crude oil down 0.5% at 73.02. But of course, we've bounced from a 67 handle, I think, last week. So they are rebounding back up, the commodities. High-grade copper is hovering around this 450 level. That's where we are basically this morning, 449.50. And to finish off, the 10-year yield is down about 2 basis points at 1.25%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.